In May 2026, the United States hit a grim economic milestone. Annual inflation reached 4.1%, its highest level since 2023. Standard economic logic suggests a number like that should trigger an immediate aggressive response: market panic, massive stock sell-offs, and swift interest rate hikes from the central bank. But when this data dropped, global markets didn't panic. Instead, they breathed a massive sigh of relief. This chart captures the exact moment of the release. While the inflation trendline peaks, the value of the US dollar, which had been sitting at a 13-month high, practically plummeted. Treasury yields dropped right alongside it. Curious, leaning in. Determining where the global economy is actually heading requires looking past that 4.1% annual total and identifying why the market refused to panic. The market reacted to the specific data points released Thursday by the US Commerce Department. The report focused on the Personal Consumption Expenditures Price Index, better known as the PCE. While headline inflation is what usually reaches the public, the PCE is the specific measure the Federal Reserve uses to evaluate the economy. Because the Fed uses this exact dial to steer monetary policy, global markets trade on its granular details rather than the broader news cycle. Looking closely at that 4.1% annual total, the pressure is clearly coming from elevated energy prices and resilient consumer demand. This split screen shows the critical difference in how that data is tracked. On one side is the backward-looking annual total. On the other, the volatile, forward-looking monthly momentum. While the annual bar remained stubbornly high, the monthly inflation increase actually fell slightly below what consensus economists had forecasted. Financial markets do not trade on past annual totals. They price in future expectations based on current momentum. Because that monthly trajectory was softer than anticipated, investors concluded that the Federal Reserve would no longer be forced into an aggressive interest rate hike in July. The absolute inflation number was high, but the slowing monthly trajectory removed the urgency for immediate tightening. When expectations for United States interest rates suddenly stall, we see that massive global capital flows begin to shift worldwide. As US Treasury yields drop, they drag global borrowing costs down with them, easing financing conditions across international borders. Simultaneously, a weaker US dollar provides immediate relief for emerging market economies by reducing the cost of their dollar-denominated debt. A fraction of a percent miss in a US domestic data report shifts the debt burden and capital outlook for developing nations half a world away. This global financial relief is happening while the US domestic economy continues to expand. This dashboard shows that underlying strength. First quarter GDP growth was revised up to 2.1%, even as weekly jobless claims continue to fall. This resilience is forcing the Federal Reserve to shift from a set schedule of rate hikes toward a stance of pure data dependency. In this era, every labor report or shift in energy prices triggers sharp reactions on trading floors. The latest numbers show that the path to lower inflation is highly uneven. Central stubborn price pressures, ensuring that market volatility remains the standard for the foreseeable future.